Hey everyone, welcome back for another deep dive. Today we're going to get into something that I think is really interesting.
Yeah.
It's mergers and acquisitions.
Right.
But we're not talking about, the big splashy headlines, the who's buying who.
Right.
We're going kind of below the surface
Okay.
to talk about how the funding of a merger or acquisition can really influence how successful it is.
The financial mechanics behind the deal can really make or break it.
Yeah, and that's really what we're going to be digging into today.
For sure.
And to do that, we've got a great article by Thomas Kessler.
Okay.
And then on LinkedIn,
Right.
there was a lot of really interesting discussion for people who've worked in M&A for years.
Yeah, so we're talking real-world experience here.
Exactly.
Not just theory.
So you know me, I love a good debate.
Yeah.
And one of the first things that came up in the article and in the comments was, the basic decision that has to be made.
Right.
Equity or debt.
Absolutely.
Yeah.
Now, you might think debt is always the riskiest option,
Yeah.
but it can actually drive some pretty positive changes under the right circumstances.
But there's always a trade-off.
Always.
So let's just break this down for our listener for a second.
Yeah.
When we say equity, we're talking about sharing ownership in the company.
Right.
Debt is taking on loans that you have to pay back.
With interest.
Right.
Exactly.
So that seems simple enough.
Sure.
But how does that actually play out when you're trying to, merge companies together?
Well, it gets complicated pretty quickly.
Yeah.
Mihir Shah, who's a CEO and investor,
Okay.
he made a really interesting comment on this article.
Okay.
He said that the type of company that's being acquired can really influence which funding route is going to make the most sense.
Okay. So for instance,
Yeah.
he specifically mentioned hardware versus software companies.
Exactly.
So why would a software company be more attractive for debt financing?
Software companies tend to have these really predictable revenue streams.
Oh, okay.
Think subscriptions, licenses, recurring payments.
Got it.
So that steady cash flow that makes lenders feel a lot more secure about getting their money back,
Okay.
even with the added interest.
Interesting.
Hardware companies, on the other hand, they usually have more irregular sales cycles,
Okay.
and they might need more money up front for things like manufacturing, which makes debt a bit riskier.
That makes sense.
Yeah.
So it's not just about the numbers, it's about the fundamental nature of the business.
Exactly. The nature of the business is going to impact that integration timeline.
Right.
And how quickly they need to see results. If you have a lot of debt, that means you need to cut costs fast and start being profitable so you can pay back those loans.
It's like hitting the gas from day one.
It is.
Whereas if you've got that equity financing,
Yeah.
maybe you've got a little bit more breathing room to figure things out.
More of a marathon, not a sprint.
Yeah.
And this brings us to something that often gets overlooked in these deals.
What's that?
The human side of things.
Right, because these are companies with real people working in them. So let's put ourselves in their shoes for a minute.
Okay.
Imagine you're an employee and your company is being acquired. How do you think you'd feel if it was a debt-heavy deal?
Well, if it was a debt-heavy deal, you might start to worry about your job security.
Okay.
Are there going to be layoffs? Will departments be merged?
Right.
There's this underlying anxiety when, there's a big need to cut costs quickly.
Yeah.
Whereas with equity, there's more of a sense that they're in it for the long haul.
Okay.
Building something new together.
More of a partnership, less of a hostile takeover kind of feel.
Exactly.
And that actually came up in the comments too.
Oh, yeah?
Tina Brown, who is a president and COO, she emphasized how often the people and the customers get kind of forgotten when everyone's focused on cutting costs.
Right.
She said, and I quote, "My experience is every time culture and customers are not key components of the integration plan, the planned synergies are not achieved."
She's absolutely right. You can get so focused on the financials that you forget that a successful merger really depends on integrating the people and the processes in a way that benefits the customers.
Right. If you ignore those things just to save money, you're setting yourself up for trouble.
You're asking for problems down the road.
Yeah. It's like trying to build a house without a blueprint.
Exactly.
You might get it done quickly, but it's not going to be very strong.
And there are tons of examples of these mergers that looked good on paper.
Right.
But totally failed because they didn't think about the people or the culture.
Didn't they try to merge those two big tech companies a few years ago? And it was a disaster.
It was.
Because they were so focused on cutting costs.
Yeah, they totally underestimated the cultural clash.
And they lost so many talented people.
They did.
And even alienated their customers because they were so internally focused.
Yeah, they forgot about what was happening in the market.
A perfect example of short-term thinking backfiring.
Absolutely. And it really highlights that tension between short-term wins and the long-term vision.
And this brings us to the idea of synergies, which you hear all the time when people talk about M&A.
Right. The idea that the combined company will be more valuable than the sum of its parts.
But it seems like there are different types of synergies, right?
For sure.
So debt-fueled mergers are all about the quick cost cutting,
whereas equity financing gives you the space to be more strategic and build something new and innovative.
But is it always better to aim for those long-term synergies?
That's a great question.
What if the market's changing really fast?
Right.
And you need to move quickly to stay competitive?
Sometimes that rapid cost-cutting that comes with debt can be the right move.
Okay.
Especially if you try to deal with a downturn, or you need to become more competitive quickly.
But it sounds risky.
It is high risk, high reward. You got to be really confident in your ability to execute those cuts without damaging the core of the business.
And without alienating your employees or customers. So there's no one right answer when it comes to funding a merger. It depends on a lot of different factors.
For sure.
And this is something that Hans-Peter Wise, who's an M&A consultant, he pointed out.
Yeah.
That most deals aren't just pure debt or pure equity.
Right. They use a mix of different financing tools.
And this is where things get really interesting.
Absolutely.
It sounds like there's a whole toolbox of creative financing options out there.
There is.
And we're going to dig into that in part 2 of this deep dive.
I'm looking forward to it.
Yeah, we'll unpack how these different instruments can be combined to really get the right balance between those short-term needs and the long-term goals.
Sounds good. You know, it's a bit like building a house. You wouldn't just use one type of material, would you?
Right.
You'd use wood, concrete, steel.
So you're saying these financial instruments are like the building blocks of a deal?
Exactly. And each one has its own properties and its best uses.
Okay.
In the article, Thomas Kessler mentions bridge loans, mezzanine financing, convertible bonds.
Okay. Those sound a bit intimidating. Can you break those down for our listener?
Sure. Let's start with bridge loans. These are short-term, high-interest loans that kind of bridge the gap between announcing the deal and actually getting long-term financing.
So it's like a quick loan from a friend when you need to buy concert tickets before they sell out.
That's a great way to put it.
Okay. What about mezzanine financing?
That one's a little more complicated. It's kind of in between debt and equity.
Okay.
The lender has the potential to make more money if the merger is successful.
So it's not just a regular loan. It could turn into ownership.
Exactly. Imagine a company is using mezzanine financing to buy a startup.
Yeah.
The lender provides the money, but they might also get the right to convert some of that debt into equity.
So if the startup does really well, the lender gets a piece of the pie.
Right. They get the interest payments, and they benefit from the increased value of their equity.
So they're incentivized to help the merger succeed.
Exactly. Then you have convertible bonds.
Okay.
They start out as debt, but the holder can choose to convert them into stock later on.
So it's like a safety net. They get the stability of debt, but the potential for bigger rewards if the stock goes up.
Right. So savvy companies aren't just choosing between debt and equity. They're mixing and matching to find the best fit.
It's about being creative and tailoring the structure to each deal.
Exactly. One size does not fit all.
So this is all very interesting, but why should our listener care about all this financial stuff?
Because it impacts whether a merger is successful or not.
Okay, but how does that impact the average person?
Well, imagine a merger that's funded with a lot of debt.
Okay.
The new company might have to cut costs really quickly.
To pay back the loans.
Right, which could mean layoffs, less innovation, maybe even higher prices for consumers.
So debt-heavy deals can be bad for everyone in the long run.
They can be. On the other hand, if the merger is funded with a good mix of equity and debt, that can create an environment where the company can invest in growth.
Which should lead to more jobs, better products.
Exactly. It's not just about the bottom line, it's about the future.
So whether you're an employee, an investor, or just a consumer, you should pay attention to how these deals are funded.
It can tell you a lot about the priorities of the companies involved.
So we've talked about the company doing the acquiring.
Right.
But what about the company being acquired?
They have a perspective too.
Yeah.
And that's what we'll talk about in part 3.
Yeah, it's easy to forget about them in all this, you know?
Right.
But they're not just, sitting around waiting to get bought.
No, they have their own goals and concerns, and they have leverage in this process.
So what are some of the things that they're looking at?
Yeah.
When someone comes to them and says, hey, we want to buy your company.
Well, let's say you're the CEO.
Okay.
And you get this offer, and it's mostly funded by debt.
I'd be a little worried.
You would.
I'd be wondering, do they really even want to integrate our businesses?
Right.
Or are they just going to cut everything to pay back their loans?
Are they thinking long-term or just short-term?
Exactly. I'd want to make sure my people are taken care of.
And that the company culture will be a good fit.
Yeah.
You might even ask for a higher price to offset that risk.
Right, or just walk away from the deal completely.
You could.
But if the offer is mostly equity, that shows me that they're serious about building something for the future.
It does.
And as an employee or a shareholder, I'd feel a lot better about that.
For sure.
It's all about trust,
Yeah.
Is it making sure everyone's on the same page?
And remember what Mihir Shah said about culture and communication.
Right.
That's super important from the perspective of the company being acquired too.
They want to know how their team is going to fit in.
Exactly.
If the values align.
Because even if the numbers look good, and the strategy seems perfect, if the people aren't happy, the whole thing can fall apart.
It's like a forced marriage.
It is.
It's just not going to work.
Nope.
So as we wrap up this deep dive,
okay,
what are the big takeaways for our listener?
The way a deal is financed, it's not just a technical detail. It's a strategic decision that impacts everyone involved.
The companies, the employees, investors, even consumers.
It's like the foundation of a building. You need to make sure it's strong enough to support everything else.
I like that analogy. So don't just focus on the headlines.
Right.
Look beyond the numbers and try to understand why they chose to fund the deal the way they did.
Yeah. Next time you hear about a merger, don't just think about the price tag. Think about how they're paying for it.
What are their priorities?
Right.
What does it mean for the future?
Exactly. It can give you a much deeper understanding of what's really going on.
And help you make better decisions as an investor or an employee.
That's a great point to end on. So that's it for this deep dive. We hope you learned something new.
I hope so.
If you want to dig deeper, we've got links to the article and the comments in the show notes.
Okay.
And as always, let us know what you think in the comments section. We love hearing from you.
Yeah, definitely.
Until next time, keep diving deep.